The current United States tax code allows some of the most profitable companies in the world to not pay any federal corporate income taxes.
The present tax system ain't fair.
Actually, at least 55 of the largest corporations in America paid no federal corporate income taxes on their 2020 profits.
And paid zero in federal taxes.
Some of these companies include big names like FedEx, Nike, HP, and Salesforce. These companies are not doing anything illegal, and these companies pay many other forms of taxes.
If a large, very profitable company isn't paying the federal income tax, then we have a real fairness problem on our hands.
And it's costing the government billions.
You can think about a bucket of corporate tax breaks that are deliberately there in the tax code. And overall, they cost the federal government roughly $180 billion each year. And for comparison, the corporate tax brings in about $370 billion of revenue a year.
Those 55 corporations would have paid a collective total of $8.5 billion. Instead, they actually received $3.5 billion in tax rebates.
Corporations can receive refunds just like individuals do.
And that doesn't include corporations that paid only some of these taxes, but not all.
The federal government estimates that there's about $40 billion each year in corporate taxes that are clearly owed.
Here's how the most profitable companies in the country avoid federal corporate income taxes. It's important to note the federal income tax is not the only tax corporations pay. They're subject to state and local taxes too. Right now, we're only talking about the corporate federal income tax rate, both domestic and international.
Federal tax rate at the moment is 21% for domestic profits, but it's as low as between 0 and 10.5% if those profits are profits of a US multinational that are earned offshore.
What do we do to make America the most competitive place in the world?
The 2017 Tax Cuts and Jobs Act slashed the 35% corporate tax rate to that 21%.
It's the only tax levied at any level that publicly traded businesses are supposed to pay in proportion to how well they're doing. Where the bigger you are, the more successful you are, the more you ought to be paying.
The corporate federal income tax, it's about 7% of all revenues that the federal government collects.
Let's look at Amazon as an example.
Alexa, how much tax should Amazon pay?
Sorry, I don't know that one.
Amazon became famous in 2018 when the company reported about $11 billion in U.S. income and paid zero federal income tax. They actually got a tax rebate of $129 million according to their financial reports. We now have 4 years of data. In those 4 years, Amazon has now reported $79 billion almost of U.S. income and has paid a total of $4 billion in federal income tax for a 4-year tax rate of 5.1%. So what that means is that they're avoiding income tax at the federal level.
Remember that the federal rate is 21%. So in 4 years, Amazon's effective tax rate was 5.1%.
I'll emphasize that everything I've just said about what Amazon is doing appears to be completely legal.
Amazon told CNBC that its U.S. taxes reflect its investments, employee compensation, and current tax laws. The company paid federal income taxes, other federal taxes, and state and local taxes. Publicly traded corporations have 2 different ways of accounting. So one form of accounting is for shareholders. Let's call it book income.
You have profits that are reported to shareholders using general accepted accounting principles under financial accounting. And the purpose of that is really to determine, is this corporation profitable? Is it worth investing from a shareholder perspective? How is the firm doing from a performance side of things?
And the second form of accounting is for taxes. Let's call it taxable income.
You have a set of rules that are different from and often diverge from that accounting. Determine how much tax a corporation is paying. And what that means is the amount of profits that corporations may be reporting for financial purposes may be very different from the profits that they are reporting and they're paying taxes on for tax purposes.
This is how some companies are able to tell investors we made billions of dollars, but turn around and tell the government we made $0. We can call all of these tools a form of tax expenditures. Tax expenditures are any targeted tax break. Think tax credits or incentives.
We want more oil. We want more solar energy. We want more manufacturing. We want higher paying jobs. We want more capital investment. And for each of these things, Congress has enacted a tax break that, at least on its face, is designed to encourage these things.
Take a tax credit for research and development as an example.
There's the R&D tax credit, which allows companies to take deductions and credits for their spending on research. The things they spend money on to, make better hamburgers in the case of McDonald's.
Tool number 2, accelerated depreciation, another form of tax expenditure. We can also call these write-offs or expensing. This is a key example of how those two different forms of accounting, book and taxable incomes, come into play.
If you are a corporation that's really in manufacturing, really capital intensive, you may make a really large investment in a given year. Under financial accounting rules to determine your profits you're reporting to shareholders, you may have to deduct that over, say, 10 years, for example, under the general accepted accounting principles. For tax purposes, especially, you may be able to accelerate those deductions in the given year, and in some cases, even taking a full and immediate deduction against your taxable income for that investment. What that means is you may be reporting a profit for financial accounting purposes, reporting no profit or even a loss for tax purposes. And that creates a difference between your financial income and your tax income.
Tool number 3, stock options.
There are tax breaks for stock options, which allow companies to write off the cost, with air quotes around it, of the stock options they give their executives and other senior employees.
So that just comes down to the different rules between book accounting and tax accounting for when that compensation can be deducted. For book accounting, it's deducted immediately. For tax purposes, it may be at a later date when it's ultimately vested to the employee, and that creates a discrepancy in the total amount of taxable income that these firms are reporting.
They write them off as if they were actual cash expense, when of course giving stock options to your employees is absolutely not the same sort of out-of-pocket expense that signing a check every 2 weeks is.
And finally, perhaps the murkiest of all tools, tool number 4, offshoring.
There is a very deliberate, at the moment, lower rate for foreign profits of US multinationals, and something between 0 to 10.5 on their foreign profits. And that's an outright tax benefit for them that's worth roughly $60 billion a year, according to the Joint Committee on Taxation. But it also creates this incentive to shift their worldwide profits into that sort of foreign low tax bucket.
US-based corporations are finding ways to shift income into tax havens. There's talk about the Cayman Islands, about Bermuda, Bahamas, Ireland, and Luxembourg, and the Netherlands to some extent.
There are estimates that sort of shifting is in the tens of billions of dollars a year, up to $100 billion a year.
Here's an example. Whirlpool, a U.S. company known for manufacturing home appliances both in the U.S. and Mexico.
Whirlpool tried to avoid both US and Mexican taxes on the profits from its Mexican operations. And it did that by having the Mexican operation owned by a Mexican company with no employees, and then having that Mexican company owned by a Luxembourg holding company that had one employee. And then it tried to claim that due to the combination of the US, Mexico, and Luxembourg tax rules, the millions of dollars of its profits from the Mexican operations wouldn't be subject to tax in Luxembourg, wouldn't be subject to tax in Mexico, and wouldn't be subject to tax in the US. So it was trying to sort of take advantage of the disconnect between all of those tax systems to avoid tax in all of those countries. And a court said, no, that goes too far. That's not what the law actually allows.
Whirlpool told CNBC that it follows all tax laws in the jurisdictions in which it operates, and that Whirlpool's use of the tax code actually increased the amount of tax that the U.S. collected on its Mexican profits. The IRS thought Whirlpool should have paid those U.S. taxes earlier.
It's still quite possible for U.S. companies to shift their intangible assets out of the U.S. to avoid taxes. And it should be a top priority of policymakers right now to prevent them from doing so.
Accounting and tax experts say that probably the first best way to fix the problem is to go to the tax rules and look at each of the different provisions and decide whether or not you want that in the tax code, repeal those inefficient tax breaks or reduce them. Some say that is unrealistic, otherwise it would have happened anyway, and it's a hard thing to do.
One solution could be to beef up the IRS.
There is nothing the IRS does that is more cost intensive, that requires more resources than investigating the tax avoiding behavior of large multinationals.
Between 2011 and 2019, the IRS's budget for enforcement was cut by about a third.
One policy solution would be to implement minimum corporate taxes, both an international minimum tax and a domestic minimum tax.
That global minimum tax would end the race to the bottom in corporate taxation.
The legislation that's been debated by Congress would raise the U.S. minimum tax rate on foreign profits from 10.5% to 15%. Implementing an international minimum tax would help tamp down on some of the offshoring of profits that companies can maneuver about.
Where that country doesn't impose at least a 15% rate of tax, then the US will impose an additional tax so that the corporation pays at least 15% in each country. And that would raise about $350 billion over 10 years.
Then there's domestic profits.
One major proposal that's come out over the last year and advocated by both Biden administration and members of Congress has been to levy a minimum tax on book income directly.
Implementing a domestic corporate minimum tax of 15% could reduce the gap between the book income and taxable income, basically cutting down the value of some tax expenditures.
The first priority with corporate tax reform should be to get it to lift its own weight, to pay for companies to pay by whatever means something closer to the statutory rate, and the book income tax would certainly accomplish that. I think there are better ways of doing it. I think there are more all-inclusive ways of doing a minimum tax, but it's certainly better than nothing.
The more money you make, the more you have to pay in taxes, right? Well, not always.
Here in the US, the more you earn, the bigger a percentage cut the government withholds from your pay. But here's the thing. The ultra-wealthy typically take advantage of rules in the tax code which enable them to lower their effective tax rate.
The rich are different from you and me, as the old saying goes, in large part because the sources of their income are different.
Just take the case of billionaire Warren Buffett. He often points out that he pays less taxes on a percentage basis than his other employees, including his secretary. The reason? Well, most of his wealth comes from his stock holdings, not his annual salary.
The great thing about stocks is that you aren't taxed till you sell them, and even then, the taxes are typically lower than the rates on wage income.
So if you ask people, what bothers you most about the tax code, complexity is a common answer, but also the feeling that the wealthy don't pay their fair share, or the feeling that corporations don't pay their fair share.
In 2018, Amazon famously pulled in over $232 billion in global revenue, and yet its federal tax bill was $0. And in fiscal year 2020, at least 55 of the largest corporations in America, including FedEx and Nike, also managed to pay no federal corporate income taxes.
There's a great Supreme Court case with Judge Hand going many years ago that it's not the taxpayer's responsibility to pay the most taxes that he can. It's the taxpayer's responsibility to pay the least taxes that he can. There's even a rule within the IRS code that if you want to pay more taxes, you can write a check to the United States Treasury and you can take a tax deduction for that.
But some experts say tax breaks are designed to reward the taxpayers who are helping to pump up the economy.
Individuals who are not, again, contributors in terms of real estate and businesses, they don't get tax benefits, but it's because they are not contributing to, the economic growth at a larger scale.
So how exactly are the country's biggest earners using the tax code to avoid paying taxes? To understand how the wealthy take advantage of the tax code, you first have to look at where all that wealth comes from.
The biggest loopholes arise when you have assets. Most Americans don't have assets. All they are depending upon is their income from their salary from their employer. So if you have someone who has assets such as business and real estate, again, they are unlocking different areas of the tax code that most individuals do not get to explore.
You can think of someone's wealth as being comprised of separate assets which fit into one of three different tax buckets: taxable, tax deferred, and tax-free.
If your only form of income is your annual salary, then all of your wealth just fits into the taxable bucket. But the rich also tend to diversify into other types of assets and investments that the tax code doesn't consider to be taxable income. There are individual retirement accounts, some of which are not subject to federal taxes, and then you have investments like stocks that fit into the tax-deferred bucket. If the value of your stock portfolio goes up, you don't owe tax on those gains until you realize that gain, aka not until you sell that stock. And even when you do sell, the tax rate is typically lower than the rates on wage income.
Capital gains can be avoided in life and also largely avoided in death. And so that's highly advantageous to high income, high wealth people.
Capital gains taxes also apply to bonds plus tangible assets. So think things like real estate or cars and boats. And with the right tax planning, you can time it such that you only realize those gains during a fiscal year when you have big capital losses to offset that gain. You can also skip the tax entirely if you pass that appreciated portfolio onto your heir when you die. Plus, owning property opens up higher earners to even more ways to chop down their tax bill.
If you own real estate, you can now deduct things as depreciation, real estate taxes, property taxes. Even if you are not investing in real estate to get rental income, even if it's your primary residence, you can itemize your tax deductions on a Schedule A, which can also lowerly affect your tax liability. On the other hand, if you do have rental properties, you can take advantage of depreciation, your expenses related to your real estate property, and earn some extra income while paying minimal tax on that additional income that you are earning.
And these strategies are just the tip of the iceberg. There's a whole patchwork of ways to drive down that annual tax bill.
There's not some magic deduction or magic credit that people overlook, and once I tell you it, ooh, you're going to get a $10,000 refund. What there is a myriad of rules, opportunities, and options to lower your taxes. I'll give you a simple example. There's almost 12 different tax breaks for higher education, whether it be the tuition and fees deduction, 529 plans where you can put money in an account and have it grow tax-free.
Borrowing against the value of real estate or borrowing against the value of insurance policies. For example, you can take out a life insurance policy with a high cash dividend and then borrow against that from a bank. The bank sees that as an actual asset, may loan up to 90% of the value of that life insurance policy. That loan is effectively income to you, but in the tax code, it's not considered income or a capital gain. So it's tax-free. So there's these kinds of techniques that can be used if you have a lot of income and a lot of assets that are just not available to ordinary people that don't have that kind of disposable income.
In 2013, many-time Grammy winner Lauryn Hill was sentenced to 3 months in prison, 3 months of home confinement, plus a $60,000 fine for not reporting more than $2.3 million in income. She isn't alone. Some of the biggest names in Hollywood have had serious run-ins with the IRS for failing to pay their fair share of taxes.
To be clear, these are all examples of tax evasion, which is illegal, not to be confused with tax avoidance, which is legal, even if it is deemed unfair by large swaths of the population.
Tax evasion is illegal and is actually punishable for up to 5 to 20 years in prison.
And the law is pretty black and white. There may be some new grayness on things like cryptocurrency, and other new innovations in the world, but most of the time you know it when you owe it. And I can certainly tell whether you owe taxes or not on a situation. But when people come in with fabricated dependents, made up deductions, phantom partnership losses, that's when you get into evasion. And evasion's the line crosser.
Those sophisticated tax strategies that we just talked about, they are all totally legal ways to avoid paying more taxes than you absolutely must.
Tax avoidance, on the other hand, is utilizing the tax code to benefit you in a way that is legal. So if there is a deduction for you having a dependent or you being able to expend something through a business, as long as you're following the tax code and the guidelines, you can take these tax positions.
Thanks to lax enforcement by the IRS, tax avoidance by the top 1% of taxpayers could exceed $5 trillion by 2029, according to former Treasury Secretary Lawrence Summers. This same report found that the top 1% account for about 70% of underreporting. So why is it that the country's top earners also tend to be pros in the arena of tax avoidance? Experts tell us a lot of it comes down to tax planning.
Wealthy individuals, tax plan. Most Americans don't have a tax plan. And a tax plan is going to encompass the CPA or tax accountant to go into the new stimulus package or a new tax reform and actually look at how they can use the new changes in the code to benefit their clients. These wealthy individuals have that guidance throughout the year to get them to a more reasonable position by year end.
A tax loophole is a provision in the tax code that allows people to reduce their taxes to a point below that intended by the lawmakers.
In other words, it's a technicality that lets the filer avoid a law without directly violating it. Not everyone likes the connotation.
Yeah, loophole's kind of a bad word. I'm not even sure what loophole means because it's either legal or it's not legal. And if it's legal, then it's not really a loophole. I would put forth it's a best practice. And what I would tell you, some of the best practice, not of just high-income earners, but any smart, savvy taxpayer, is to take advantage of all the tax rules in the law.
Once embedded in the tax code, it's pretty difficult to get rid of a tax loophole. Each one not only benefits somebody by saving them money on their taxes, but it also typically has an army of lobbyists backing it up.
Sometimes they're not partisan because they are more about protecting a given economic sector or even specific businesses, and that has to do more with the locale. It might be more about what parts of the country, what states, what congressional districts have a certain economic sector that's very important.
Essentially, the U.S. tax system creates an incentive-based system for those who aspire to achieve wealth. And here's why. You get tax credits for having a business or having real estate. In that act, you are creating opportunities to employ people or creating opportunities to house people. Unemployment and homelessness are two of the major concerns for any government. So why not give tax incentives to those who are going to assist in creating a way to aid these issues? So if you close out tax loopholes and tax incentives, we don't know what the outcome would be, because this can potentially discourage individuals who are contributing to the vast growth of our economy to not make those contributions at a more accelerated rate.
Despite the quagmire of opposition, the question as to whether or not to close loopholes often pops up in elections and with new administrations. Just take the Biden White House. The president is taking aim at some pretty popular loopholes in the tax code, though it remains to be seen whether he'll succeed.
Wealthy New Yorkers may soon be getting the highest local tax rate in the nation.
The combined city and state taxes will be 14.8%.
In early April, the New York State Legislature passed a $212 billion budget for fiscal year 2022. Among spending cuts, it includes tax increases on the wealthy. Others have done the same.
New Jersey raised that top rate from 8.97% to 10.75%. for those making $1 million or more.
Revenues are bleeding, and states have to do something.
Honestly, if I had the choice of taxing the wealthy more or preventing someone from dying on the street, I would always choose the other.
Raising taxes on the wealthy is contentious. While advocates say it's fair in a way to decrease inequality, others say it'll drive the wealthy out. After all, the 1% are critical to state revenues, paying up to nearly 50% of total state income taxes.
There is a pack mentality to wealth. When all your friends are now in Florida and you're the uncool guy or woman who's in New York, that is something that could be a tipping point for why this becomes less of a trickle, as we've seen over the past 3 or 5 years, and more of a flood.
If they leave, there's a huge fiscal crisis. How do you pay for all of these services? And that affects everyone.
While tax flight is often talked about, it's hard to prove empirically. Someone may move for warmer weather or to get closer to family, and it just so happens that taxes are lower where they're moving. What we do know is that millionaires and billionaires are highly tied to where they live and make money.
Considering I can do what I do from here in South Florida, having no income taxes is a great draw, for sure.
If taxes were your sole consideration where you were doing business, you weren't in New York anyway. This, again, is really different.
At the early stages of the pandemic, wealthy people left to seek safety, not to save on taxes. And they have now spent over a year in their second homes and are no longer bound to their offices in New York City or San Francisco, or their children's schools. Raising taxes at this fragile junction could make the decision to officially relocate easier, and that could have serious repercussions for state revenues. Will the wealthy flee cities and states with high taxes?
COVID-19 pandemic has dealt a heavy blow to America's states.
In the early months of the pandemic, state lawmakers were warning of unprecedented fiscal crises in nearly every state. The Brookings Institution estimated revenues falling by $155 billion in 2020 and $167 billion in 2021. More complete data later showed that states ended fiscal year 2020 in better shape than initially expected, mainly thanks to federal aid and the unusual nature of the recession, where wealthy and high-wage earners' economic situation only got better. Even so, local government officials have remained weary. Limitations on borrowing to fund day-to-day operations left states with two options: cutting expenses or raising revenue.
When we talk about economic recovery, rich people don't need a recovery. They're actually richer right now than they were before.
Among spending cuts, a number of states have either passed bills or are considering tax hikes on the wealthy to balance their budgets.
I mean, I'm happy to pitch in and pay the taxes for infrastructure, for education, for technology advances. If it's not going to some of those things, it does make it a little harder to support.
New York's tax increase may be the most rigorous, involving several tiers, starting for those earning $1 million to $25 million and above. They expire in 2027.
Now, I lived in New York, worked in New York, and now I'm going to live and work in Florida. And obviously, one of the reasons I'm doing that is for the lower taxes.
It is very easy for financial firms to move to Florida because they don't have a huge headcount. Those are the guys, the hedge fund guys, who make far and away more than the Wall Street guys, the biggest salaries in New York City. And so it doesn't take a lot to have a big impact on tax revenues, especially if you've been away and you say, you know what, that's what they're going to do. I'm just not going to come back.
You also can't ignore the evidence of 15 to 20% commercial vacancy rates and lower asking rates, and generally a picture that suggests the city's property taxes are going to be depressed for quite a while, at the very best.
Despite early reports that California was going in the same direction, in January 2021, Governor Newsom rejected the policy. The state had an unprecedented year and ended with a budget surplus of $15 billion. But this wouldn't have been the first time the Golden State would tax the wealthy.
In the 1990s, the tax cut didn't do anything to millionaire migration. Neither in or out migration was affected. The millionaire tax in 2004 didn't do anything. The millionaire tax in 2012, which was larger, had small migration effects. To the extent that there was an effect, it was mostly driven by people sort of finding ways to, essentially hide their money or find ways to report less income on their tax returns.
In December 2015, the wealthiest man in New Jersey, David Tepper, moved to Florida.
He pays so much in taxes that it's going to screw up possibly the entire state budget.
It was covered by most media outlets, and although he never explicitly said why he made the move, many assumed it was for tax reasons.
Frank Haynes, he's the legislative budget and finance officer to the Senate Budget and Appropriations Committee of New Jersey, says, quote, "We may be facing an unusual degree of income tax forecast risk if news reports are true that the person ranked by Forbes as the wealthiest man in New Jersey has shifted personal and business domicile to another state."
Tepper moved back in September 2020.
There's just this sort of one-way interest and anecdotes and stories about millionaire migration because, it fits a story, but when you hear the counterexample, people don't know what to make of it.
Young has devoted much of his career to studying the mobility of high-income earners based on taxes, but he's one of the few. The idea that tax policy affects location decisions of wealthy individuals has a long history, but the empirical evidence is limited.
Unless you interview people as they're getting on their U-Haul or G650 private jet to go to Palm Beach for good, you don't know what their reasons are and how those reasons stack up. It's always hard to say people move for tax reasons. What we can do and what we are studying is the parallel causality or coincidentality of higher taxes and out-migration.
According to Young, though, it's simple. Millionaires and billionaires spend a lot on trying to reduce their tax burden by hiring creative accountants and lawyers. They travel a lot, but they don't move a lot, and taxes are rarely their main consideration.
I always thought about it, of course, right? I mean, taxes are important.
That's John Caden. He's a member of Tiger 21, a peer membership network for high net worth individuals.
But really, I was motivated to be in New York City and develop my career there. After my marriage, didn't work, and I moved from New Jersey into the city, I recognized there would be additional taxes. New York and New Jersey are around the same at the state level. but I had the additional city taxes, and it was worth it for me.
New Jersey is my home. This is where I go to see doctors. This is, where I have all my contacts. And I clearly, taxes aren't going to be the motivational factor that's going to get me to move or re-domicile.
Those sentiments are true for most Americans. Rich or not, more than 2/3 live in the state in which they were born. And the 1.5% to 2% that do move from one state to another do it because of losing a job or family. And it's nearly as likely that those moves are from low tax states to high tax states. Of the ones that do move to a low tax state, it's primarily folks with low incomes rather than high.
The reason that people are moving is largely housing prices. And then they, oftentimes they feel like there's a lack of opportunity in that state.
Anecdotal evidence tells a different story. The Boyd Company is a site selection consultancy. They help clients choose the right location to operate their business.
Over the past decade or so, with respect to the exodus of California, markets like Phoenix and Las Vegas and Reno and Salt Lake City have been big beneficiaries. These are states that hold the line on taxes, that aren't in this never-ending game plan of borrowing, taxing, and spending. And the property and income tax savings for a relocating worker from San Francisco or Los Angeles to a no income tax Reno or Las Vegas, for example, are just enormous.
This is one of the greatest moves to the suburbs from urban areas.
We expect there will be something close to an exodus from these really large cities where housing is so expensive.
For months, news reports, preliminary data, and anecdotes suggested that the pandemic had ravaged state budgets. And because of the mass urban exodus, states should be weary of increasing taxes on the wealthy. States took 2 austerity measures and spending dropped by 6% in the second quarter. In reality, many states and cities ended the year in decent shape, especially with the arrival of President Biden's American Rescue Plan. California had a record year, and New York City's budget generated a surplus of $3.4 billion instead of the initially projected $4.2 billion deficit.
The wealthy and companies in New York are saying, wait a minute, we actually were on board fixing that giant hole we had. But if we don't have the hole anymore, that's a very small hole, and you're not cutting, and you're just going to tax us because there's a moral argument, well, then we don't want to be here anymore.
This, for a relatively small revenue hole, has the potential to become a self-fulfilling prophecy. If you're worried about the revenue losses because people aren't coming back, then probably the worst thing you can do is impose varied taxes that would make them not come back.
As for that mass exodus, it didn't happen. Except for March and April, patterns mimic 2019. Data collected by a number of moving companies show that the biggest inbound states were Idaho, North and South Carolina, and Maine. And the biggest outbound states were New York, Illinois, California, and New Jersey. Looking at regional data, California didn't experience a pronounced exit either, just fewer people moving in. Moves in and out of those living in the wealthiest zip codes were similar to other zip codes, except for in the Bay Area. There, net domestic exits increased 178% for the entire area and 649% for San Francisco alone, compared to 2019. But it doesn't appear people were escaping the high taxes. Nearly 80% stayed in the state. That's why looking at plummeting rent prices only tells part of the story.
The reason why there's so many anecdotes about rich Californians moving away is because there's an enormous population of rich Californians. If you want to pull out like a lot of examples of them doing anything, go to California. You'll find just an enormous base population to draw on. But, who's leaving California are lower income folks who can't afford it.
The data aside, there are plenty of anecdotes of wealthy individuals leaving urban areas. They've been gone for over a year, and making it permanent will likely be easier than ever before. The question is, will it be enough to make a serious dent in New York and other states' revenues?
The pandemic just kind of sparked me to really think outside the box and think I can do this from anywhere. Even more since I've been down here, I felt the swell of businesses moving down here for sure.
There is now an emotional component to what was an existing financial component for why more want to leave. And again, we may find out that it was overblown and they didn't leave. The challenge is it will be too late.